Okay, good evening, everyone. Hello.
Good evening, sir.
Okay, good evening. I just want
Good evening, sir.
Good evening, sir.
you can hear me. Good evening. Okay. Um. So I welcome each and every one of us into our lecture two with two. So I want to welcome everybody. I can see Annie Fowoche. You are welcome. I can see Josephine. I can see Olusegun. I can see Amaka Mustafa, Margaret. Let me see. I can see Angela. I can see Bukola. I can see Blessing. I can see Edward. I can see Femi. I can see Adasa Idowu, Kayode, Michael, and Pete, Rachel, Samuel, and Yolaku. So I welcome each and every one of us um, into this our second lecture for case study. Sorry. So tonight we are going to be um, moving into another uh, sub, like class two of our lecture. Um, but just to bring ourselves to memory lane, last week we discussed, um, last week we started with introduction to case study. We looked at what is case study and we looked at the competence required for case study. We look at the things that we're supposed to know that will help us, handle case study. And I promised that I was going to share the course outline on the Telegram platform, which I have done. Have we all seen it? Did we get it? Did we get the course outline that we dropped on the Telegram platform?
Yes, sir, we did.
Okay, I didn't. Oh, okay, I didn't check, so maybe I will check it now.
Please, you can check. I actually dropped it on the Telegram platform. I dropped it on the Telegram platform. Okay, so basically today we are going to be looking at financial statement analysis, part one. Financial statement analysis, part one. That's going to be what we are going to be looking at today. So last week we started with introduction to case study. So this week, which is class two, we are going to be looking at financial statement analysis. Now, for financial statement analysis, we are going to be looking at the definition. What is what is the whole essence of carrying out financial statement analysis? And in our first class last week, we made it clear that there are three important or major analysis that will be required, that they carry equal marks, the same 33% weight of marks or weight of the same weight, the same importance are given to the three, which number one is what? The financial statement analysis. Number two is financial data analysis. And number three is strategic and operational analysis. So I said last class that we are today, by in our subsequent class, which is today, we are going to be looking at financial statement analysis. And today we'll be looking at the definition of um, um, financial statement analysis. Why do we carry out financial statement analysis? what are the objectives of carrying out financial statement analysis, what are the things that financial statement analysis entails. This class has been divided into two. We are going to look in detail the theoretical aspects this class. Next class, we will try as much as possible to solve a practical question. This area, there are areas that, you know, the reason why we are doing this lecture is beyond writing exam and passing the exam, you need the knowledge. You need you need to understand because financial analyst is a profession. It's a profession you can decide to go into as a career. So it is important. In fact, this is a major, it's a separate course in stockbroking exam, financial statement analysis, a paper on its own. But we have it as a one of the subjects or one of the topics to be treated under case study. And if you look at the whole of case study itself revolves around financial analysis. So we are going to look at the definition, the objective, the purpose of carrying out financial statement analysis, and what financial statement analysis entails in this part one. We are going to look at the types of other analysis we have, who are the users of financial statement analysis. Some of them, they are things we have already, but I want us to pay a close attention and uh, then we'll be able to drive home the point. Okay, now when we talk about financial statement analysis, number one thing for us to know is that financial statement analysis is analysis of how a business has been performing in the immediate past. How a business has been performing in the immediate past. That is, in the immediate past means in the last 1 year, in the last 2 years, in the last 3 years, in the last 4 years, or in the last 5 years. If you look at the information on the balance sheet, which is now called statement of financial position, they are past information. They are information about things that had already happened. They are the expenses that are the money that has been spent. That is what we are analyzing. Get it? Financial statement analysis is all about analyzing how a business has been performing in the immediate past. That is, that is why we have something like 5 years financial summary, 3 years financial summary. We compute trend analysis to know how has this business been doing in the immediate past years, in the last 1 year, in the last 3 years. How has this business been doing? That is number one. So, and it is financial statement analysis looks at how the business has been performing in the immediate past years. Why financial data analysis, it looks at the current issue that the business is facing. I want you to know the difference. Financial statement analysis look at the past, how the business has been doing in the past 2 years, in the last 1 year. Meanwhile, financial data analysis look at the current issue, present issue that the business is having. That is financial data analysis. Meanwhile, operational or strategic and operational analysis is considered the future. It considers the future. It considers the knowledge you have from your financial statement analysis. It combines it with the conclusion or knowledge you got from the financial data analysis in order to project into the future, in order to prospect the future of the business. That is, if we look at in the last 5 years, this business revenue grows by 20%. Like there was analysis I did with I think it was for last diet or last two diet. We saw that revenue has been growing consistently on a growth rate of 20%. You can say from that knowledge that all other things being equal, secondary variables, this business has capacity to grow revenue by 20% in the next 2 years, in the next 3 years or 5 years into the future. That is interrelationship or interconnection between financial statement analysis, financial data analysis, and strategic and operational analysis. Again, what is financial statement analysis? Financial statement analysis can also be viewed or can also be described as evaluation. Look at it. Evaluation, that is assessment. Evaluation or assessment. Evaluation and explanation of financial and non-financial data contained in a financial statement. Now, look at it. We are looking at another definition of financial statement analysis. We say that it is evaluation and explanation of financial and non-financial information contained in the body of a financial statement. Now, the question is that financial statement is a body of reports that contains statement of financial position, statement of financial performance, statement of cash flow, and statement of changes in equity. Changes in equity. That is financial statement. So I said that financial statement analysis can be described as the evaluation and explanation of financial and non-financial information contained in the body of a financial statement. In the body of a financial statement. Now, when we say in the body of financial statement, sometimes that statement could contain management accounts. That is why sometimes in the exam, you will be given management accounts. Sometimes it could contain budget, a budgeted report. Sometimes it could contain a forecast. It could contain a forecast about the business. That is another way to describe or to define financial statement analysis. So, financial statement analysis, like we mentioned, it evaluates financial performance, financial position, cash flow, and statement of change in equity. Let me give you another definition. Financial statement analysis can be viewed as a way or process or approach of identifying the financial strength and weaknesses of a business. Financial statement analysis can be described, can be defined as a way of identifying the financial strength and financial weakness of a business by establishing relationship, by establishing the relationship between the statement of financial position, statement of financial performance. When I mean statement of financial performance, I mean income statement or comprehensive income statement or statement of comprehensive income. It is the analysis that tries to find out the relationship between the statement of balance sheet, P or L, cash flow statement, and change in equity statement. That is what financial statement analysis is all about. Another question is that you need to know that financial statement analysis help you to take one decision. Please take note. It helps you to take investment decision. It helps you to take investment decision. In management accounting, there are three decisions you can make. Number one decision is investment decision. You can make financing decision. Financing decision. You can make operational decision. You can make dividend decision. Dividend decision. These are various decisions in management accounting under financial management, under strategic financial management. These are three decisions, and that's why those decisions are represented in the body of a cash flow. They are represented in the body of a cash flow, in the body of a cash flow statement. So, but what we are saying tonight is that you need to know that financial statement analysis helps you to make one decision. That decision is investment decision. That is, as an investor, you want to know whether a business is doing well and if the business is viable or profitable for you to invest into. Now, on a flip side, on a flip side, what determines financial statement analysis is the person and the purpose. Is the person and the purpose why financial statement analysis is being carried out. The focus of carrying out a financial statement analysis is dependent on the person who asked, who requested for the financial statement analysis to be carried out, and the purpose why it is being carried out. Let me give you an example. If you want to apply for a loan in the bank, they will say, bring your financials. They want to know where, they will say, bring your cash flow. They want to use it to know whether the business can finance, whether the business can pay the loan and pay the interest on the loan. So when we talk about the person and purpose, let me give you an example. If it is an investor that asks you to carry out financial statement, and if it is an investor, if you are viewing financial statement analysis from investor's point of view, from an an investor's point of view, it means that financial statement analysis will be carried out. It means that financial statement analysis will be carried out to predict the future performance of the business. That is the purpose. If it is an investor that has to carry out, that means the financial statement analysis will be carried out with the view, with the objective of what? Predicting the future of the business. That will this business continue to make profit in the next 5 years? But if it is a management or board of directors that ask you to carry out a financial statement analysis, the objective may be to understand the present financial condition of the business, to understand the present financial condition of the business. You can see now investor perspective, management perspective. But it is important for you to know that financial statement analysis is probably carried out for investment decision. That means when we say that financial statement analysis is carried out for investment decisions, it means that we are looking at it from the investor's perspective, from an investor's perspective. Another thing for us to important thing to know is that financial statement analysis, there are key performance indicator, KPI, key performance indicator that shows, that help to carry out financial statement analysis. What are the key performance indicators? Number one, liquidity ratio. Number two, solvency ratio, profitability ratio, efficiency ratio, and investors ratio. That investors ratio can be said to be like a short or long-term perspective of the business. Something that helps us to see, oh, what in the short time, what will this profit business be doing? In the long time, what will this business be doing? What are the contents? And we have already mentioned the four important contents of the financial statement. We said that statement of comprehensive income, which is P or L that we used to know, statement of financial position, which is the balance sheet, statement of changes in equity. We used to call it appropriation account. That's what we used to call it in the olden days. It is now called statement of changes in equity and statement of cash flow. You will notice in the past question, these are the four areas you normally see in a question that will use it to carry out a financial statement analysis. And we have also mentioned that a financial statement analysis can be used to measure financial health and future prospects of a business. Financial health. If you are given in a case study that carry out an assessment to evaluate the financial health and future prospects of business, they are saying that carry out financial statement analysis. And what are the indicators? If your carry out your profitability, your efficiency, your liquidity, your gearing ratio, in order to be able to what? Ascertain. In order to ascertain what? The strength and the weaknesses of the business. Let's look at what are the objectives. There are various objectives of carrying out financial statement analysis. There are various objectives. Number one, like we have said, financial statement analysis is carried out to evaluate the strength and weakness of a business entity. Financial statement analysis is carried out to evaluate the strength and weaknesses of a business entity. Number two, financial statement analysis can be used to measure the profitability of the business, the profitability of a project. To measure the profitability. As we all know, when we talk about the corporate objective, profitability is the most common profit business objective. Every business is set up to make profit, profitability objective. So, financial statement analysis is carried out to measure the profitability of a business. Number three, financial statement analysis can be carried out to determine, to ascertain patterns and trends of business performance over the year. To determine patterns and trends of business performance, of a business performance or of a company's performance over the years. Another objective of carrying out financial statement analysis is to determine determination of future earnings capacity, determination of future earnings capacity of the business entity. You want to determine the capacity, earning capacity of the business. Another one is that financial statement analysis, another objective is that to determine the liquidity and solvency of the business. To determine the liquidity and solvency of the business. Another reason, another objective of carrying out financial statement analysis is to ability to compare the business performance and the past position over the years. Ability to compare the business financial performance and financial position in relation to other businesses, in relation to other businesses over the years. Another objective of carrying out financial statement analysis is ability to assess, ability to evaluate the growth potential of the business or of the company. The growth potential. Do they have, does this business have ability or capacity to grow by 20% in the next 1 year, in the next 2 years? Ability to ascertain the growth potential of the business over the years. It is important for you to note that beyond the financial information, beyond the statement of financial performance, beyond the statement of financial position, cash flow statement, there are other data that will be provided that will help you carry out an effective and efficient or a reliable analysis of a financial statement. What are these data? Sometimes we cannot entirely rely on the balance sheet, income statement, cash flow to carry out a reliable analysis of a financial statement. There are other information that we need. What are these information? Number one, sometimes you may need the market data. The market data. The market where the business operates. What are the information? If you look at the last diet question, they give us information about the industry where the business operates. They give us the growth rate of the business in the industry. They gave us that these are the gaps. These are the gaps that have not been covered. These are the growth. These are the area of this business that has not been touched. This is the percentage of the area that has been touched. This is the location that the business has covered. Because if we know the location that the business has covered, we can deduce the areas that the business has not covered. If we know the percentage of growth that the business has achieved, we can deduce the percentage of growth that the business has not gotten to, that has not been achieved. So, other information useful to the accurate or reliable computation of financial statement analysis is market data. Number two is economic data. Economic data. What's happening in the economy? Number three is operational data. How is the operation of the business doing? What are the limitations? Those data, they are given to you as data for you to work around it. Look at it. Last diet question, we were analyzing it, and we saw that the company is paying too much tax. We are now to use our knowledge of tax planning to be able to advise the company. So you will need economic data, you will need market data. That is where the wider context, when you are interpreting, you are not interpreting considering only the financial data alone. You have to consider the non-financial data that could affect. You remember, when we define materiality, one of the concepts in accounting, we say materiality is something that the inclusion or the exclusion can affect the economic decision of users of financial statements, the inclusion and the exclusion. So all these other factors, market data, economic data, operational data, these are the things that are material to be considered when you are carrying out financial statement analysis, because they could alter the decision outcome of your calculation or of your analysis. They could alter it. Hello, are we together? Hello, are we
Yes, we
together? Can
are.
you hear me?
Yes, we are. Can hear you.
Yes,
Okay,
sir.
thank you. So these are the factors that should be considered when carrying out statement of financial analysis. Let's quickly look at the techniques for financial statement. Number one, we have what is called comparative approach or comparative analysis. This comparative analysis is, can also be known or called horizontal analysis. Now, this analysis is when you are comparing the business financial statement over a period of time, that is 2 years and more. Now, I want us to take note. Let me cite example for you to be clear, for it to be clearer. If we are given 2015, 2016, 2017, if you are comparing the financials of 2015 to 2016 and you are comparing 2016 to 2017, that is called comparative analysis, comparative approach of carrying out financial statement analysis. But if you are computing trend trend analysis, you have to make 2015 as the base year to compare with others. If it is trend analysis, say you have to make 2015 as the base year. You will not use 2016 results to compare 2016. You use 2015 results to compare 2017. You use 2015 results to compare 2018. That one is called purely trend analysis. But if you are using 2015 results compare with 2016, you compare 2016 with 2017, 2017 with 2018, 2018 with 2019, it is called either comparative analysis or you can call it trend comparative analysis. It is called trend because you are doing more than 2 years. A normal comparative analysis is 2 years. You are comparing 2015 and 2016. That's comparative. 2 years. You are just comparing their results. But the moment the year is more than two, it has been, you are trying to understand the pattern in the business. When you are doing 5 years, that is trend comparative analysis. But if it is only trend analysis, you will make a year as the base year. You will make 2015 as the base year. Hello, can you hear me?
Yes, sir.
Yes, sir.
Now, okay, thank you. So we have I've just explained two together now. Comparative approach or comparative analysis, which is the same thing as horizontal analysis. And I've explained trend analysis. That's number two. Number three is common size analysis or common size approach. Common size analysis or common size approach. Common size analysis is vertical analysis. Vertical. Common size is that you will make if you are carrying out common size analysis and you are looking at it from income statement perspective. If it is income statement, you will use sales, your turnover as the base, as the basis of comparison. Common size analysis, you will use if it is income statement you are using, you will use your revenue, your turnover, your income as the base as the basis other things. I will give you an example. So if you are carrying out a vertical analysis, which is called common size analysis, you will use, if it is income statement, you will use your income or your turnover, your revenue as the basis. So you are comparing that. If let's assume that your revenue is 1,000, you are going to compute that, okay, what is the percentage of cost of sales to revenue? What is the percentage of admin cost to revenue? What is the percentage of taxation, tax paid to revenue? What is the percentage of depreciation in the same year? In the same year, one single year. You have other parameters that, okay, what is the percentage of profit after tax to revenue? That is called common size analysis or common size approach to to financial statement analysis. If you are trying out a financial using a common size approach or using a vertical approach, if it is income statement, you use your turnover as the basis. If it is balance sheet, you use your total assets or net assets as the basis. If it is balance sheet that you are using, you use your assets, total assets or net total assets as the basis of comparison. So you want to check what is the percentage of debt to total assets, what is the percentage of fixed income debt to total assets, what is the percentage of current assets to total assets, what is the percentage of the loan to total assets, what is the percentage of turnover to total assets. That is called a common size approach to statement, financial statement analysis. Then another one is cash flow approach. Cash flow or what is called working capital approach. Working capital approach, that one is simple. You are just trying to know what is the working capital in this business. Sometimes you have to carry out a operational cycle or cash cycle. But what that one, the easiest way is to just compare what is the percentage of total current assets to current liability. That is what that one is measuring. You are comparing what is the percentage of, and that is what liquidity. And when we talk about liquidity ratio, you see have various levels. You have quick ratio, you have current ratio. You understand? You have cash ratio. Are you getting? You have cash ratio. You have all other like that you can compute to be able to know your cash flow approach to financial statement analysis. I want you to know that there is difference between profitability and liquidity. A business may be making profit, they are not liquid. And a business may be liquid, they are not making profit. They are two different things. They are two different things. But the purpose of cash flow analysis is to reconcile profitability to equity. Is to reconcile profitability to equity. That is why in cash flow you will see that we had back non-cash items. We had back to profit non-cash items under indirect method of cash flow statement. We had back non-cash because we are trying to reconcile profitability to equity. That is what cash flow approach does. All of these are some of the things that we learn now that later in practical we go training abroad to go and learn because they are relatable. They are things that they do in the bank to say whether a client is qualified for a loan or not. These are things that KPMG, the big four, are doing, collecting big money from companies to be able to evaluate the position of their business. This topic we are treating is more than just writing and passing ICAN exam. You need this in the profession. You need to understand financial statement analysis as it were. So we have mentioned four of them: comparative approach or comparative analysis, common size analysis, cash flow analysis, trend analysis, and we have explained before. Because of our time, we are going to look at I don't want to bother us much with financial ratio. I've already mentioned the four ratios or five of them that we are going to be looking at: profitability ratio, liquidity ratio, efficiency ratio, which is otherwise called activity ratio. We are going to look at long-term solvency ratio, which is also called gearing ratio. Long-term solvency ratio, which is also called gearing ratio or leverage ratio. We are going to look at investors ratio or investment ratio. Those are the five: profitability, liquidity, efficiency, long-term solvency, and investors or investment ratio. Don't forget that liquidity ratio is also called short-term solvency ratio. It's used to measure in short term, can this business continue to pay salary? Can they pay government taxes? Can they meet up with the short-term financial obligation? That is what liquidity ratio computes for you. Those are the things. Can this business continue? Can this business remain in business in the next short foreseeable period? Because any business that has liquidity problem, it means that going concern is threatened. A company may not make profit and remain in business, but when they begin to have liquidity problem, it means that going concern of the business is already threatened. So we're going to look at the ratio under it. There are some of the things we are going to go and read up. They are in our manuals, they are in our video lectures. They are the things, but we'll just mention them. But these are the things. And in the next class, we're going to be looking at another important thing before we go. Is we're going to be looking at when you look at you don't just compute financial statement analysis. You look at who, I mentioned something. Who is asking me? Because it is the who that determines the purpose. If a government is asking you to carry out, maybe you work with FIRS, you work with Lagos State Internal Revenue or the State Internal Revenue, and you are computing financial statement analysis, there is something you are looking for. Are they paying their tax? Will they be able to continue to pay their tax? If you are a member of the public, you are computing, you are looking for social responsibility, the impact of the business on the business environment, on the community, on their immediate community. If you are an investor, you are computing statement, you are computing financial statement analysis, you are looking at, will they be able to pay dividends? In management accounting, we call it shareholders wealth maximization or appreciation. You are looking at it. If I'm an investor, I'm carrying out financial statement analysis, I want to know that, oh, will my investment appreciate in the next 1 year? When I'm buying MTN shares, I want to know, I'm making that investment decision. I want to know, will their share appreciate in the next 1 month, in the next 2 years? When I'm buying GTB share, when I'm buying Zenith share, I want to know, will the investment, will it appreciate? Will I maximize return? It is who, and these are the things. You must know, who are you computing this for? It is who that determines the purpose, and your calculation must go in line with the purpose. It must go in the line with the purpose. So that is why when you are writing a report, you don't just write a report in the ICAN a case study exam. You want to know who is asking them to write the report. What would be the objective of the person? Why? What's the purpose of writing the report? Because whatever you are writing, you must channel it towards achieving the objective. Just in an organization, whatever we are doing, it must be channeled towards achieving the corporate objective of the organization. Whatever everybody does, it must be channeled towards achieving the corporate objective of the organization. In the same way, when you are computing financial statement analysis, you must know who is asking us to compute it so that you can work towards the purpose. Because when the purpose is not achieved, the essence is defeated. The essence is defeated. So we're going to stop here for today, and by next week, we just do a little bit of theory and go into calculation, and that will be it for financial statement analysis. And after financial statement analysis, we are moving into another interesting topic, which is financial data analysis, which is more broader than financial statement analysis. Financial statement analysis more of calculation, how to interpret this and that. We will now go into financial data analysis and see other things that we should know as it relates. Don't forget, this topic is more than passing ICAN exam. You need it as a professional. The knowledge that you must have. Thank you. God bless you. So that will be the end for today's class. God bless you. I
Thank
don't
you,
know if
sir.
anybody has questions.
Thank you, sir.
Uh, Earlier, you didn't give us the course outline to this
I dropped it on the Telegram
session.
chat, but I can repost it. When I get home now, I will repost it. I will repost it on the Telegram, the course outline, so that everybody can follow. I will repost it tonight.
Okay,
Good, sir.
So, yeah.
I'll be expecting it.
Thank you, sir.
Okay.
Thank you, sir,
Thank
and
you.
good night.
Good
In
night,
the
sir.
Good
absence of
night,
no
everyone.
question, good night. Good night, everybody. Good night. Thank you. Bye.
All right.
Good night. Thank you very much.